Thanks, Carol. We appreciate it. Thanks, everybody, for joining us. We appreciate you being here. We're going to take you guys through a really quick pass of trade spend and then open it up for you all to ask questions since you have Jen and Justin on the phone as well. Quickly, this is the agenda that we had for today. We're going to try to walk you guys through each of these pieces with really three goals in mind. One, really want to introduce everybody to the lingo and a lot of the terms that you'll encounter with trade spend as you launch into retail or with distributors. Two, we want to talk about how trade spend is a big part of growing your brand, but also a very big part of your financial success as a young brand. We at Propeller interact with that quite a bit with our company, so we want to share that with you. And lastly, we wanted to leave you all with some tips of how to go forward and manage your trade spend better, some things to do, some things not to do as you are growing your brand. Quickly, just so you guys have an introduction of who we are. On the webinar today, you have me, Justin, and Jen. Collectively, we are leading Propeller's trade spend efforts, which is a service offering, which we'll talk about in a second. All three of us, in one way, shape, or form, have quite a bit of experience in the CPG world. Jen is our resident trade spend expert, quite a long track record working with brands and helping manage their trade spend. Justin, quite a long track record of working with Propeller's clients and others as a finance VP to help our clients manage their finances and grow their brands as well. And for those of you that aren't quite familiar with Propeller, I just want to give you a little bit of brief background on how we actually landed here with Branch Foods. Propeller itself was founded in 2008 with the idea that young, growing companies, in particular consumer products companies, really need a certain level of finance and accounting support. But it's really challenging to figure out how to hire the right people and what exactly you need as a young company. And so our goal was actually to bring to our clients the full finance and accounting stack and be able to support our clients both as they're small and as they scale, from bookkeeping to having a controller, all the way through FP&A and having a CFO to advise our clients when they go through major events like fundraising. So we act as the outsourced finance and accounting function for our client base. On the right-hand side here, you can see a lot of the services that we offer in the finance and accounting realm. We also started to offer some other services to our clients as they've grown and as we realize there's other things we can be supporting them in. Things like fundraising, helping them set up the right systems for their firms, but also trade spend. And that's something we're going to talk a lot about today, but we do have a practice focused on helping support our clients in managing their trade spend because it is such a big part of their business and we want to help them do that successfully. Next, this is a list of a lot of our clients. Without going through all of them, one thing I wanted to point out that's really going to weigh in this conversation is you guys can kind of look at the left-hand side. A good 60% of our clients are consumer products companies, which means over time, since the inception of Propeller, we've been working with a lot of brands that have been selling through retail and through distribution. And over time, we've really begun to put the pieces together and see the patterns about what it means to have trade spend and manage it successfully, the pitfalls, the challenges, the wins in our client base. As we've started to recognize those opportunities, we've been able to start helping them manage that well. And that's a lot of what we're going to try to share with you all today, or a lot of those lessons, a lot of the things that we picked up over time that we think you all should know before you get into it or as you get into it that can help you get your brand off the ground successfully. Okay, so we're going to get into the meat of it, and Justin and Jen are going to take over here in a sec. The whole first section, we figured we'd want to give you all a background of what we think trade spend is, what we're seeing. And we're going to take you through a lot of the specifics and a lot of the terms that you're going to encounter as you venture into retail and distribution one by one. Before we did that, I thought it might be a good opportunity here to survey the audience here to get a little sense of what you all know about trade spend and what your background is with trade spend, because there's quite the spectrum in the audience. So I'm going to launch a poll here in the webinar with a quick question for you all about what your level of knowledge is of trade spend. And then we'll look at the answers here in a second. together. It is okay if you're on one end or the other. All right. Okay, I'm going to start with the fact that there are 4 people that have already said that they're experts. And we should talk afterwards about that if you're looking for a gig. All right, so let me end this and share the results with you all. Can everybody see this? Looks like we have some people that are new. That's very common. A few people have been exposed to it, but you're right, it is a foreign language, we're not going to lie. A lot of you right there in the middle with some knowledge, some have been around it for a while. So a good mix in this audience. I'm going to track down those 4 people down there, by the way, to see who you are, you experts. So let me stop sharing this. I'm going to turn over to Justin for a bit here to help walk us through what trade spend is. Justin, I think you might be on mute, by the way.
Knew I was going to do that. Thanks. Hi, everyone. Let's go to the next slide, Lucas. Yeah, so let's start here with kind of the basics of trade spend and talk about what trade spend actually is. We've got a lot of information on these slides. I'll do my best not to actually read through them. And please submit questions as they come up or as you think of them. I'd love to just answer those kind of as we go, as opposed to saving them until the end, but there will be time at the end for questions. So to start with, trade spend is the money that you spend as a new brand, or any brand really, to drive customers to purchase your products. So we will sometimes or often use trade spend as a broader term to cover a bigger variety of spend that we'll talk about here a little bit more detail in a couple slides. So more broadly, trade spend is used to refer to that spend to drive customers to purchase your product, but also costs that are associated with opening new distribution or just kind of doing business in various retail and wholesale channels. It's typically required in a number of instances, but really we as new brands are interested in using trade spend and leveraging the benefits of trade spend to help gain awareness of your brand and drive customers to try out your new brand. And then there's also kind of requirements of the retailers and distributors to spend a certain amount on trade spend. So we'll talk about that a little bit more later too. This is where we start to get into a lot of the jargon and sort of terms that are specific to trade spend, but it comes in many forms. It can be as simple as a straight percentage discount on your products that customers are getting, to a buy one get one free, or a 5 for $5 promotion. But there are also things like slotting fees and free fills that are used to open up new distribution. Now, the reason trade spend is tricky to deal with is because you're most often not actually writing a check for a promotion to a retailer, or writing a check for a slotting fee to a distributor or a retailer. They're just simply deducting those amounts from their payments back to you. So it's pretty rare once you start getting into distributors and some of the regional and national chains to actually receive full payment on an invoice, because there are various deductions for things like early payments or a promotion that you ran, or fees, which we'll talk about some of those and how to potentially avoid some of those. Great, next slide. All right, I love this slide because it really shows or illustrates the importance of trade spend, I think. We are, of course, managing a lot of it for our clients. We've got over 100 brands that are selling in retail at this point in time, which amounts to over 100 million in total trade spend annually for us. But as you can see in the pie chart on the right, trade spend can be 20% or more of your total revenue. So if you look at that pie chart as your total revenue, we're cutting out the piece for COGS, and then we're showing 20% here, but it can be up to 35% of your total revenue that you're spending on these various trade spend buckets. So it's a critical to, one, understand, and two, understand the impact to your gross margin ultimately, because gross margin is what drives your business. All right, and if you go to the next one, Lucas, got it. So typically at Propeller, we think of trade spend in three different buckets, right? And I said a couple slides back that we use the term trade spend to refer to a kind of a broad spectrum of various types of spend. The first bucket that we will kind of break trade spend into on the P&L is new distribution. So this is costs that are associated with opening up new doors or new channels and getting on shelves, right? And we'll kind of go into each of these in a little bit more detail further down in the presentation. The next and probably biggest bucket is the trade and promotions. So this is what is often referred to as working trade, meaning that the spend here is what's actually getting to your consumers and what's actually driving velocity at the shelf. So this is where your discounts are falling and other promos. And then the last one is returns and allowances. And this is where a lot of people can get tripped up or forget about this bucket because it's not driving sales necessarily. And it's just things that come up, or this is where all those fees happen. Spoilage is a good thing to watch out for. Returns happen here, damages, shortages, and term discounts. You don't want to forget about those because a lot of retailers and distributors will require those as part of doing business with them. So we'll talk about all this in a little bit more detail here in just a sec. But let's pause right there and see if do we have any questions?
None yet.
Good. All right.
Oh, wait, hold on. When is it appropriate to dispute a deduction? Is that one we want to punt on, and we'll get to that later on?
Yeah, I mean, it's a great question, and a lot of this stuff can be disputable, and we can certainly come back to it. But I think the short answer is if it's not a valid deduction. So you'll have various agreements and contracts with these retailers and distributors. And so if someone is charging you back for a promotion that is not within the agreed upon promo period, or if they're sending you a shortage charge for something that you actually fulfilled, then that's when it's appropriate to dispute deductions.
And as we get to the end, when we get to some tips and tricks, one thing we'll talk about with everybody is some things you can do to better set yourself up to track these things, because it's also very hard to dispute things that you aren't aware of. So we'll walk you guys through some tips about how to set yourself up to track what's going on. That way you'll have the information you need to dispute it.
Yep. All right, so we're kind of, if we keep going here, Lucas, yeah, we're going to break this out, the next couple sections, into those three buckets that we just talked about. And so we'll start with new distribution here. The two biggest items you'll see here in new distribution are free fills and slotting. And this is kind of they're often kind of used interchangeably, and it just kind of depends on the retailer or the distributor that you're working with, which one that they prefer to do, but they're both accomplishing the same thing. So free fills is really sort of, you're agreeing to give a retailer a certain amount of cases for free in order to get your product on their shelf. So that cost comes in the form of product, and then a slotting is just a straight monetary charge. So it's usually, it can vary. Sorry, was there a question?
No.
It can vary by, this also varies a lot by retailer, kind of how much they charge, but it also varies by category and where you are in the store, as well as kind of where you are in the shelf. So like those eye line level shelves are going to be more expensive to get onto than the floor or a top shelf, because that's kind of the highest traffic area for customers. And that's usually done as a dollar amount per sort of facing, per SKU, per store. Let's move on, Lucas.
Yep. Also, I think one person raised their hand. If you have a question, it'd be great to put it in the Q&A, because I don't know. Or we'll take you off mute.
Yeah. And then so free fills and slotting are the biggest ones here in the new distribution bucket. Then there's some other fees that may come along from like distributors, like KE and Unify can have new item setup fees just to kind of get your item added into their systems and things like that. These fall under new distribution, but are generally, you're spending less here than you are on those slotting and free fills.
Yeah, just I think one thing we wanted to call it here is I think as you're getting into new distributors or retailers, you should expect to see some of these things. It's become a part of their business model to charge brands for these things. Justin, is there an opportunity to negotiate on these things when you do?
There is, yeah. Like, so a lot of this stuff I'm going to talk about, and I'll say stuff is required. I mean, a lot of this stuff is negotiable. So always keep that in mind. It's tough when you're an early brand, you don't have much leverage, and you're kind of have to take what you get in a lot of instances, but like, it doesn't hurt to try to push back on some of these things. So here we're saying, like the slotting fee could range anywhere from $100 to $1,000 per SKU per store. And that adds up if you are launching in like Whole Foods into 400 doors or 500 doors. That adds up pretty quickly. So you can try to negotiate some of those things. I've had some clients that have gotten to a little bit of scale and been able to negotiate their way out of doing any off-invoice discounting with the distributors. So it just kind of depends on the leverage that you have and how well you're performing, and also what your relationship is with the buyers. All right, now we're getting into the fun stuff that's really kind of driving your velocity. We're going to go over a lot of terms here, and don't feel like you need to write these down. We'll share this deck with you guys, but this is by no means an exhaustive list of everything that you could potentially run as a promo. So we'll cover a few of the most common ones here, but there are a lot of ways to go about promoting your products that would all sort of fall under the category of trade spend. MCBs stands for manufacturer chargebacks, and this is sort of a catch-all bucket. It can mean any number of things. So a lot of these ones that we'll talk about after this can sometimes fall into this bucket if you're not tracking them on a more detailed level. So manufacturer chargebacks is what you need to understand there. The next one here is temporary price reductions, or TPRs, and scanbacks. And a lot of stuff will fall into here too. This is when you're reducing your price by a certain amount for a certain period of time, or running a BOGO, which is buy one, get one free. And all that comes through at the register, and then the retailers are passing that back to you directly if you're selling directly to the retailer, or through the distributors that they're purchasing from.
Which is a great example of what you said earlier, Justin, which is a lot of these you will not pay for up front, but that next payment that you're set to receive from them, they will go ahead and
Right.
deduct it from your payment. And sometimes just given the timing of these things, it might be a very large portion of that check that you were.
Yeah, most of them, most of these, like 98% of these, you will not get an invoice for. So it doesn't hurt to keep reinforcing that. Like, keep in mind that you're never going to see an invoice for these. They're just going to send you a check that says, hey, we're paying this invoice, and oh, by the way, we're withholding all these other amounts from it, so we're not paying the full invoice. So you need to be aware of that. EDLPs is another form of price reduction, but you see this commonly in chains like Sprouts, where you've got your sort of suggested retail price, but you may negotiate what's called an everyday low price. Walmart is sort of famous for this as well, where you're just kind of cheaper on their shelf at all times. So there's just kind of a constant price reduction happening in that chain.
I think one thing we want to point out here is when that does happen, the retailers and distributors are going to keep their margin, which means that ultimately the brand itself is going to be the one that pays for this. And we get a little bit antsy about this with our clients because we want to make sure that our brands understand how they can price their product and what it's going to do to their margin. If they don't have much leeway, they are going to eat most of this cost. So we want to be very careful about how much you can absorb.
Yeah, so that, like, understanding your full variable cost margin is very important when you start to plan out these things. And again, this is another area that you could potentially negotiate on, especially after you've been in a retailer for a little while. Say you're launching Sprouts and you've got like a 10 or 15% EDLP in there, but like you're just struggling to make any margin at that discount. That's where you can go back to a retailer and say, okay, it's working at this price point on your shelf, but we're not making anything here, so we can't sustain this. You can negotiate with them. I've seen clients do things like split the cost of that discount with the retailer so that they're covering some of the discount so that you don't have to cover all of it. And that helps you start to claw back some of that margin. And then this next one here that we've got is online or in-store discounts. These are really, this is also its own, probably could be its own webinar here, but we will typically, for non-digitally native brands, we'll kind of bucket all online discounts into a single line item on the P&L. So what else can we do? Coupons, yes. Coupons is a big one. And it's a little bit interesting because there's often like an administrative fee associated with coupons that we don't treat as trade spend. That can go in your operating expenses, but the cost of that discount still needs to be captured above. So coupons, I think everyone generally understands. Of course, if you have any questions, we can talk about that. But typically you're using a third party to sort of administer and run the coupon program. And that cost you can keep out of your margin and in your operating expenses. And then off invoice discounts, my least favorite of all. Off invoice discounts are given directly to the distributors, and they will often require a certain number of off invoice discount periods per year at a certain rate, just to do business with them. This is another one you can negotiate on, and please do negotiate on this and try to avoid these as much as possible, because they do not get passed on to your customers, and they do not drive your velocity at the retailer. This is purely a discount that's given to the distributor, and they're not passing on those savings to the retailers or the customers, right? So it's spend that really doesn't help you grow your brand.
I think the other dark side that we've noticed with off invoice, because we are giving discounts to the distributors themselves, it gives them the incentive to order a lot of your product.
Yes, yeah,
Unfortunately, sometimes that leads to them over ordering your product. I think you've seen that too, right,
yep. So
Justin?
they'll, yep, exactly. So if you're, especially if you've got a long shelf life, they will stock up when you're on promo and then not order for 2 or 3 months until the next promo period, right? One other quick note about these, they work a little bit differently than the rest in that they show up actually on your invoice when you're invoicing a distributor. It's a little bit counterintuitive because they're called off invoice discounts. So it's a discount that's taken off of the invoice. So it's not an actual chargeback. You're just giving it to them up front. It's another line item on your invoice, if that makes sense. All right, and then our last bucket of trade spend is the returns and allowances. There's a bunch of things in here. This bucket tends to be smaller than the rest, but it can add up if you're not careful. So you've got things like customer returns. Product can be returned to you for a number of reasons, from like damaged product or just unsellable product. It just kind of depends on your agreements with those retailers and distributors. Shortages, you really want to watch out for those. That's an area that we have had a lot of success in disputing those, because the warehouses make errors as they're receiving stuff, or for whatever reason. But if you're able to show that you actually did fill a PO in full and on time, you can get a lot of those back. Spoils, you want to be really careful about what your spoils allowance is with a retailer or a distributor. Some of them have what's called full reclaim or 100% spoilage protection, where essentially they're not taking any of the risk of selling that product. So anything that they aren't able to sell before it expires on shelf, they get to charge you back for. So you want to be really careful about setting limits with your distributors and your retailers about what they're able to charge you back for in the form of spoils.
Justin, it strikes me this is a category where you really want to read the fine print when you sign
Yep.
on with distributor. Yep. And also for those of you who have an ops person on your team or somebody leading the ops side of your business, it might be you yourself. This is actually a big category that we notice. It isn't quite the CEOs or founders or the sales team that's interested in this. It's actually the operations team that is most interested in seeing these things, because they're the ones that can help mitigate them or do the disputes based on what's happening on the ops side of your business. So just another audience inside your company that might be interested in understanding what's happening here.
Right, yeah, but both the shortages and the spoils, right? Like on the shortages especially, it could, like if you're getting a lot of shortages, they could be valid. And if they are valid, that highlights a process issue on your side with your operations team that you can go to your operations team and then kind of help them figure out what's going on or what needs to change in order to stop receiving those shortages. All right, we're almost through these terms, y'all, I promise. So next up in returns and allowances is damages. This is where you might get billed back for any product that arrives damaged, or we've also had cans exploding on shelves and things like that, which you never want. But retailers will charge you back if that starts to happen. And that's another kind of operational issue. So whether it's cans exploding or like a case pack or a pallet that fell apart in shipping, like those kinds of things can also show up. Term discounts is one that is really common, and almost everybody requires some sort of early payment discount, and they will try to take it. This is another opportunity for disputing, though we've had less success here than we do with the shortages. They start the clock when they receive the inventory or when they receive the invoice, whichever is later. So whichever one benefits them more. And then they've always got some excuse about why why the clock didn't start when, and why they actually are valid in taking that discount. So they're always going to take the discount, but you need to really double check them on that and make sure that they're paying early. And then we just kind of got other allowances down here. There's some other things that may show up in the form of chargebacks, like the Whole Foods allowance, which is new since the Amazon buyout a couple years ago. Both Unify and KeHE have add-on services that show up in the form of chargebacks as well, that a lot of our clients use, and they're not necessarily required, but it's tough to do business or kind of make any sense of the information without those. All right, that's all of our terms for now. There's a lot more. So if you want to go deeper down the rabbit hole, we can certainly talk about those, or if you have questions about certain terms you may have heard that we didn't address, throw those in the Q&A, and I'm sure Jen can answer them without even getting out of bed, but she'll have her opportunity to display her vast knowledge of trade spend here in a minute. All right, we're getting there. This is great. I don't really know what to say about this other than I love it.
Let's watch it over
Ferrell. Yeah, here's Will Ferrell just loving some discounts in the store. So I guess now that we've got like at least a general understanding of what trade spend is, like, you might be wondering how to use it to benefit your brand or your business. I think the key things to think about are like focusing your spend on tactics that drive velocity and drive trial for your brand, and that's going to vary depending on what your product is and what your brand is, but that also means at the same time avoiding those off invoice discounts that we talked about, that spend that doesn't drive your brand. So not only off invoice discounts, but a lot of those fees that we just covered, like the more you can limit those and the more you can keep those down and sort of run a tight ship, the more capital you're going to have to either spend on trade spend to drive growth or spend elsewhere in the business. Also, kind of use the data that you can. Early on, it can be tough to get access to data just because it's expensive, but talk to your buyers, ask them for any data they can share. You can buy data from like Spins or IRI or Nielsen. That's the expensive stuff. Whole Foods, you can get access to pretty good data from them, but use the data at your disposal to help make some of those decisions. And also think about timing of those promotions too, and how those work for your brand. So if you're a condiment brand, or and you know you've got sort of high seasonality in the summertime, like time those promotions around those kind of peak sales to really drive some velocity there. And then of course you want to limit the off invoice discounts and the fees, right? So negotiate all of those things. And I think the last thing I would say on this slide that we should probably put up here next time we do this is like, get help with this stuff. Like, you don't have to do this by yourself. And nobody, I think, expects you. I don't think they teach this in business school, right? So nobody expects you to know it if this is your first time through. Like, ask your advisors, ask people like Propeller or other firms out there, but get somebody to help you. Ask your brokers. Your brokers can help a lot with some of this stuff. So get somebody to help you along the way. Don't try to go it alone.
So Joseph, if I heard that correctly, do focus on the things that will reach your customers. Don't focus on the things that stop with the distributors themselves, correct?
Right. Well, said another way, I guess, yeah, don't focus dollars on those things. Like, you want to focus on limiting those off invoice discounts and things that don't drive discounts to your customers. So don't ignore them, but you want to, yeah, definitely limit them.
Justin, I did see a question in the chat since you just mentioned the data and trying to get access to the data to see what's working.
Mhm.
Joe asked, well, one, data is expensive. Any hacks you've seen from other companies in getting access to some of the data? Do you need store level data or just regional, national, good enough to get started?
I mean, it depends what you're trying to do with that data or trying to solve for. But some of the hacks I just mentioned, like asking your buyers for data or like one thing that you can do pretty easily is sort of understand from your buyer like what their expectation of velocity for you is on the shelf and what you're doing there. Like they can tell you how you're performing. And so if you're underperforming, then you know you need to put some capital to work there to help drive that velocity up and get up to what they would consider to be successful so that you avoid being discontinued.
Is it true that they have to meet a certain requirement themselves as a buyer so they have the same vested interest to see where you are and share that with you?
I may defer that one to Jen, but I would say I don't know if they're like required to meet certain velocities in their category, but they are sort of their performance is judged on how well their category performs. So I think most of the times they're setting what those velocity requirements are for themselves to be successful. Do you have anything to add to that, Jen?
Yeah, like the distributors will share with you if there are any underperforming items that are not moving through the warehouses and being reordered by the retailers. So there's definitely a threshold of underperforming SKUs. And like you said, it varies by category and what the buyer's expecting.
Mm-hmm. All right, so we talked a lot about sort of what is trade spend, and we've got a couple of slides here on just kind of how it shows up in your finances or in your financial reporting. This could also go pretty deep. We're going to touch on it lightly here. Definitely want to save some room for questions. So I'll go over this quickly. So here we've got just a sample P&L. You've got your gross revenue at the top there, and then trade spend right under that. So trade spend is what we call in accounting a contra revenue account or a contra account, which means it is sort of a reduction in revenue. So most of the stuff that we just talked about will show up in this line item and get reduced or deducted from your revenue to get to a net revenue, or you might hear people call it net sales number. Brands are often valued off of this number as opposed to that gross revenue number. And the reason for that simply is you could be doing 100 million in revenue or 50 million in revenue, but spending like 40 or 50% on trade spend and essentially just buying those sales through discounting, right? So you're not necessarily running a profitable business that way. Like you could if you had really great product margin, but it probably don't at that point. The other thing here that we want to just point out, and we'll talk about gross margin here in a second, is how that trade spend impacts the gross margin. So you're reducing the revenue by the amount of trade spend, and then reducing that number further by the amount of your cost of goods to get to your gross profit or your gross margin. And then
I think one thing we wanted to point out is that we obviously encounter a lot of young companies that are coming into us for the first time and helping them with their financials. A lot of discussion about what needs to live up in trade spend versus down in OpEx, and through a lot of conversations with our clients, and then also with a lot of auditors and investors, a lot of the things that you all saw before do in fact need to live up in trade spend, and it's just an ongoing battle to understand what has to go up there and affects your margins versus what can go down into OpEx. We do a lot of work with clients to help them understand that so they can get to a better margin number, a better benchmark for their business.
Mm-hmm. Let's stay here for just 1 second, Lucas, because I just want to talk about the gross margin, even though I know we've got it on the next slide. So that, just to be clear with everyone, the gross margin is most often calculated as your gross profit over your net revenue there, as opposed to gross profit over your gross revenue. That's why if you look at that gross margin percentage that we're showing there is 43%. That's why it's 43% and not 35%. So it's gross profit over net revenue or net sales.
And by the way, when you guys get the presentation, you'll have more details here that we didn't speak to.
Yeah, sorry, I'm just trying to move quickly here because we're running short. So we talked about gross margin. Investors will focus in on gross margin, and it's, as I mentioned, this is sort of the lifeblood of your business. So gross margin is what you have left after your sales to run the rest of the business. So investors are using this to gauge profitability and the health of a brand, and compare prospects as they're looking for investments to make. Oops.
Get there.
Yeah, we're getting there. So investors will hammer on this. You'll hear them talk about it. So you will want to have a good understanding of how it's calculated, what your gross margin is, and if you're selling multiple products, even what your gross margin is sort of by product. And just if I can give you a benchmark here, most of our clients are targeting roughly a 40% gross margin as sort of like an exitable margin threshold. So that's a lot of them aren't there yet. And so we see a lot sort of in the 20 to 40 range. And so they're all trying to find ways to get to that 40%. And of course, as we've seen, trade spend has a big impact on what that ultimate gross margin is. So the more, it's a tricky balancing act, right? Because you need trade spend, partly because your retailers and distributors are requiring it, but you also need it to help drive the growth of your brand and drive trial. So on one hand, you want to limit it because it's impacting your gross margin, but you also you don't want to bring it all the way to zero, because then you're not going to be able to grow as quickly.
All right, thank you. We're going to turn over to Jen quickly before we get to the Q&A. We just want to give you guys a list of tips that we are obviously around to dig into these as well and help support you if you guys have questions about this. But there's just a list of things that we've learned over time that we think would be helpful for you all as you're thinking through how to best manage and use those dollars effectively, like Justin was talking about. So Jen, do you want to walk us through?
Absolutely. So definitely take time to know what you're signing up for. Most of the retailers and distributors have manuals and guides that'll kind of tell you what is required versus the things that you can opt in and out of. And like Justin mentioned, everything is negotiable. So definitely have conversations around what you're signing up for and what you're agreeing to. Same thing here, making sure that you're syncing up with your sales team and or brokers. They're the ones that are going and signing these deals on your behalf. So make sure that they have guardrails in place on the pricing you want to allow, and make sure that they're not writing off too much.
That's one thing we've noticed, because they're incentivized to go out there and sell more. That might sometimes mean that they're offering more than you might be comfortable with. So it is good to get on the same page with them.
Yeah, and it's usually always driven by trying to get to a certain price on shelf. So, and again, same here, kind of playing out the impact of what those deals and offers are gonna cost. Again, velocities are the unknown here, so it's definitely hard, but kind of doing mini P&Ls to understand with the margins and the wholesale price, because a lot of deductions through distributors are taken off at the wholesaler cost, not necessarily the cost that you sell it to. So you definitely want to kind of plan out the financial impact by promotion and contract that you're writing up.
Jen, I imagine the big buckets here, the new distribution, the slotting and free fills, those really big charges that happen up front.
Yeah.
To play out.
Yeah, a lot of times those are similar to like a flat fee. I'd say by category, they're a flat fee per SKU, per how many doors they're going to launch you in. But free fills, again, are a free case per store. But again, those come off the wholesale cost. So you actually lose money on every free fill. So just knowing those up front and planning them out will help. And again, just setting up your system properly so you can track this stuff so it doesn't become a big black hole, and kind of itemizing it out simple in the beginning so you can analyze it and see what kind of deductions and spend is coming through.
And Jen, perhaps the easiest thing to do here is one, make sure that trade spend does live on your P&L up below
Exactly.
revenue. And then maybe even just separating it in those 3 buckets would be a good starting point.
Yes, absolutely. Yeah, getting as granular as you feel you need to be able to make some sense of what's coming through. And again, stay current. Checks are constantly coming through. You don't know if there'll be 1 or 50 deductions on a check. Try to stay as current as possible so you can address them as quick as possible. Some retailers have time constraints on how long you can dispute them. Some are a little bit more lenient, but you definitely want to stay on top of those so they don't snowball out. And again, this is kind of double checking what you kind of forecasted. So if you were expecting a certain scan deal with Whole Foods to come in at a certain amount, maybe when it comes through, doing some spot checks to see, were you close? Did it add value? Did it increase sales? And do some analysis on that to make sure it's, you know, was valuable for you guys. Always fight back. Somebody asked earlier on when you dispute a deduction. If you don't feel that you offered it, definitely dispute it. If they have a substantiating claim that you did offer it, they will usually provide you with that information. And especially anything operational, shortages, and non-compliance issues, if you are following the rules, it could just be a paperwork issue, but staying on top of them and not letting them just, again, fall in that black hole will be very valuable. And again, here, creating the narrative, which kind of comes down, it's different by retailer, different by channel, but seeing how your spend is adding to the growth of your business. Like Justin mentioned, are those scan deals pushing more velocities out when you're running them? Comparing some of the data that you can get from third parties and from some of your retailers directly would be really helpful to look at some of those things. And then, as Justin mentioned too, phone a friend, ask for help. You're not alone. I think all of these brands are in the same place and have all the same pain points. Take the time to look at least the big ones and make sure you're understanding what's going on. And we're always here to reach out to. And yes, make sure you're getting your awesome product into the customer's hands. So again, those scans are great, and coupons, anything that's going to drive those velocities is really going to be your most valuable trade spend.
That's what we want to leave you all with. I think we know that trade spend for our clients, particularly new founders of food and beverage brands, trade spend is a foreign language, like some of you mentioned. And we know it can be confusing. We know it can be a big dollar amount sometimes. We know there's a lot of terms thrown around. I think at the end of the day, if you can set up the right systems to track that as it happens, you can get back to what matters, which is actually just figuring out what's going to help you get your customers to try the product at the retailers. And if you can really just zoom in on that with your spend, you ultimately be the most successful. Everything around that, you want to limit it and fight back on those things. It's not actually helping you grow your business. But sometimes it's hard to see the forest through the trees. So as you're doing this, just make sure that you know ultimately those things that you feel are going to help your brand grow and focus on those in that process. Looks like we have about 8 to 10 minutes to open it up to Q&A. There's the Q&A box on your screen. If you want to click on that, happy to answer questions.
I believe there's some in there.
Yeah, we got some. I'll start with the first one that I see there. Question is, of the average 20% trade spend, what percent is attributed to new distribution, trade and promotion, and returns and allowances? Very broadly speaking, I would say like roughly 50% is working trade or trade and promotions, and then 2 to 4% is new distribution. That really depends on sort of how much distribution you're planning to open up in any given year. or any given period, and then returns and allowances is typically like 1 to 2%, if you're doing a good job managing all that.
The next one is, should my broker be negotiating these fees for me?
Absolutely. So I mean, certain things are not negotiable when it comes to fees, like an ad fee will be a certain one, but there's sometimes tiers of ad fees that you can negotiate depending on the one you want to run. But yes, they can definitely negotiate those fees. I would say more of your operations team would be negotiating like spoilage fees and those type of fees. But any allowances and allowances off your scan or MCBs should be negotiated probably through your broker or your sales team.
I imagine that's one of the reasons you're paying them, right? Is to help you negotiate that and get out there in front of the retailers and do this, which I think is so important to get on the same page before they do that, because you don't want them offering something that you think is ultimately going to work against you. By the way, there is a separate question over in the chat. Paul was wondering, is there a central source of info to interpret the different deduction codes that distributors might use?
There is, each one has their own. So like on the KHE website, you can find, they have a lot of good helpful docs. It's just trying to navigate that website and finding them is probably the hard part, but they do have the little, like a code cheat sheet for each one, and UNFI does as well. Same with Walmart and Target.
Yeah, if somebody's really looking for it, they could also send you an email too. It'd be helpful to.
Absolutely. Happy to help.
Ada's asking, do brand new small business e-com shops need to factor in trade spend?
A little bit.
I would say, yeah, I would say yes. It's not nearly as complicated as everything we laid out here, and it's more just kind of offering discounts through whatever digital channel that you're selling through, whether it's Amazon or your own website, or something else. But that's, generally speaking, a lot less complicated.
Can you speak more to free fill for stores? What's a good ballpark for stores and companies that may ask for too much?
Free fills, they're usually, I would say 1 free case per store is okay. I have seen clients and suppliers be able to negotiate down to a half a case, depending on the list cost probably of your case. And it also depends on the case pack size. Sometimes they'll do split cases, but it's usually 1 free case per store. If you're shipping direct, it's off the list cost you're selling it to them. But if you're selling into UNFI and KHE, it's going to be off the marked up cost that they're selling to that retailer. So it could be up 20–30%.
Thanks. Another one about the recommended percentage between new distribution and working trade. I think, Justin, you answered that. The real curveball there is if you're launching into new retailers or distributors, we'd expect to see a fairly significant spike in new distribution. So it kind of muddies the waters there. But on a running basis, a majority of this should be working trade.
Yeah, so working trade might be more consistent at like 15 to 20% of your revenue. And then like new distribution is going to vary greatly kind of depending on timing of those launches and how many retailers you're launching into in a given period.
And you usually have control over that timing too. So you can stagger it if you don't want to take a big hit in the same month.
Which is important too, because I imagine most of you are thinking about your cash and how to use your cash effectively. Being able to time that and stage that really does matter, because it's going to eat into your cash balances pretty quickly. What's the benefit for a small brand to do an EDLP?
Some require it. Like say Wegmans, if I'm not mistaken, Wegmans requires an EDLP through UNFI. But if it gives you a reduced price on the shelf for that EDLP and it's going to be running at a reduced price on the shelf, it might not be an invaluable EDLP. What Justin meant earlier probably is that you don't want to necessarily give every customer an EDLP across the board for the full year.
So I guess if you really think that that's a retailer or a channel that you want to go after and it's worth it, it's worth exploring. Just don't get stuck doing it for too long or doing it too broadly. Okay. From a trade management, that's a good question. From a trade management perspective, aren't off invoices easier to manage than traditional MCBs or EDLPs or scans? Is there?
They're absolutely.
Yeah, I mean, yeah, they're easier from an accounting perspective to manage, but as we mentioned kind of in the the deck there, that spend does not get to your consumers. So it's not helping you drive sales or velocity or any of those things that are important to actually growing your brand.
And
So that
again, it
makes
does
sense.
matter who you're talking about when you say the off invoice. A direct customer that's going to get you a reduced shelf price would be worth it. UNFI and KE doesn't necessarily get passed down to that retailer.
Any advice for disputing the term discounts taken by UNFI when they pay the invoice?
Oh, the whole point of their PPs? Love this question, by the way. The PP process is basically in order for them to capture that cash discount. And they're actually very transparent about that. There's a little document I could share, but they're going to take that terms discount no matter what, but they are paying you the invoice up front. But I know then they're deducting it again. They're going to pay on receipt of goods, not on the receipt of the invoice copy. So they kind of just play with it, but they're doing it to basically take those terms, unfortunately. I have not been successful at disputing those. Sorry.
Tilt the cards in their favor. Justin, this one's for you. On top of trade spend, what percentage of net revenue should a brand be spending on marketing? So this would be marketing down and OpEx.
You're on mute.
Did it again, sorry. It's a tough one. It kind of depends on the size of your brand, and generally speaking, like all of the spend buckets below and above the line should kind of decrease over time as your brand grows. But an early stage brand might spend anywhere between 10 to 20% on marketing below the line expense. Yep.
So I asked this one, Jen, this might be for you. How can we use trade spend to prevent OOS at retailers? Should we attempt to incentivize the distributor or the retailer?
I mean, honestly, that sounds like a buyer conversation because obviously they're not replenishing on time. So, I mean, it depends on the retailer you're referring to, but I would think you would want to have a conversation with the buyer that they should be ordering more frequently. If this is a retailer that buys through a distributor, the only other thing I know to push some of those velocities is to push like one of the monthly special deals or one of those ad fees that UNFI will list out or KE will list out to their retailers to purchase your product. But I'm not sure who you're specifically referring to. They usually are on top of out of stocks and don't want that.
Jen, OOS stands for?
Out of stock, I think.
Okay. Yeah.
We are a little bit over time, so one last question, which is very interesting. Have you seen any changes on the historically favorable trade spend practices related to women, minorities, veterans, disabled owned, or local vendors? Are there retailers that are more favorable or more aggressive in some of these things, where they're offering different deals to different groups?
I do know that a lot of them have special like connections with, you know, women and minority owned. I don't know if they offer special deals in allowances, but I will say there are certain distributors, certain retailers that don't charge slotting per se, and another one might. So I don't know if it's specifically related to those categories, but it's worth asking.
And the last one, Justin, this might be for you before we wrap up, is do we factor PR spend into trade spend, which is maybe a broader question about where do we draw the line between marketing spend versus trade spend?
Yeah, that goes below the line in marketing. That's the short answer. We don't factor PR in, and we can, like, there is a gap definition of what goes above the line and below the line. And generally speaking, it's things that are kind of tied to the sale of the product and that you cannot get from a third-party vendor. So PR most often is run through a third party, and it's not usually run as a percentage of sales.
Are there other good examples for everybody here of other marketing expenses that actually can be below the line that are not considered trade spend?
Sorry, marketing expenses or sort of trade spend?
Marketing,
Deductions.
marketing expenses. No,
So
marketing
other marketing expenses, like the biggest one obviously is advertising and all the many things that kind of fall under that bucket. But there are some deductions that come back that can go below the line as well. So sometimes there will be ad fees that show up as deductions, which we'll book below the line. There are sort of, you can purchase special placement within the store on an end cap maybe, or on a pallet in the middle of an aisle. And those costs can go below the line as well. So there are some other sort of unique deductions that we can put below the line to not impact gross margin, but by and large, most of them do go above the line as that contra revenue account.
Well, we are over time. We appreciate everybody joining and taking the time to hear us out. And again, we're around, so if you have questions, I'll defer to Jen and Justin actually, but feel free to get in touch. And Carol, I'm sure you can point them our way as well.
Yes, thank you, Lucas, and thank you, Justin and Jen and the entire Propeller team for helping the community better understand trade spend, which is a complex subject or topic, but also highlighting the importance of trade spend and growing a brand and gaining traction in retail and in the industry. And thank you all for attending. As a reminder, we will send you all the recording and a link to download the detailed presentation slides, so be on the lookout for an email. We have 2 upcoming retail seminars on national expansion and functional beverage brands on February the 17th and the 24th at 4 p.m. Eastern time. So all the sessions are free to attend. Be sure to sign up for them. And if you have any questions or would like to engage with us, please reach out at info@branchfood.com. We would love to connect. And thanks again, Lucas, Jen, and Justin for this very useful and insightful presentation. Stay safe, everyone, and enjoy the rest of your day.
Thank
Thanks,
you,
y'all.
Carol.
Thank you.